Are you looking to make tax-free gifts to your children, grandchildren, or other loved ones in 2025? Do you want to make sure you're doing it the right way without triggering tax issues or losing control of your assets? Well, then stick around because in this video, I'm going to break down exactly how much you can gift, how to maximize your giving strategies, and some hidden pitfalls you need to avoid. Hi, I'm Chuck Roulet. I'm an estate and elder law planning attorney licensed to practice in both Florida and in Minnesota. And before we begin, if you haven't already, make sure you click the like and subscribe button so you'll be notified when I post new videos like this one. And if you have a question, post it in the comments below and I may answer it in an upcoming video. And if you stay until the end, I'll share some resources where you can discover more. So here's the big number for 2025. You can gift up to $19,000 per person without filing a gift tax return. That means you can give $19,000 to each of your kids, grandkids, and others totally tax-free. And if you're married, there's great news. You and your spouse can each give $19,000, meaning a married couple can gift up to $38,000 per recipient without any tax implications. That means you could give a combined $76,000 to your child and their spouse as just an example. And do you want to give even more without triggering taxes? Well, you can actually pay for someone's tuition or medical expenses without it counting towards the $19,000 limit. But here's the catch. You must pay the institution or the provider directly. So for example, if your grandchild's tuition is $50,000, you could pay it straight to their college and still give them $19,000 on top of that. Now let's quickly discuss the gift tax myth versus reality. You see, the gift tax isn't really a tax. Most people hear the term gift tax and they panic, but here's the truth. The IRS doesn't actually tax either the giver or the receiver of the gift unless you exceed your lifetime estate tax exemption. And in 2025, that exemption is $13.99 million per person. But here's where things get tricky. On January 1st, 2026, that exemption is set to drop to $5 million with an adjustment for inflation. So if you have a large estate, gifting now while the exemption is high could save your heirs millions in estate taxes later. However, there are certainly risks and downsides to gifting that you need to know and consider. So before you start writing those checks, let's talk about a few gifting risks you need to watch out for. First is the 3-year look-back rule. If you pass away within 3 years of making a gift, the IRS might pull it back into your estate for estate tax purposes. The second is the 5-year Medicaid look-back rule. So if you or your spouse apply for Medicaid to cover long-term care or nursing home costs, any gifts made in the last 5 years can disqualify you from receiving benefits that you may otherwise have been entitled to. So a 3-year look back on gifts for tax purposes, a 5-year look back on gifts for Medicaid qualification. The third thing to consider is a loss of control. Once you give a gift, it's theirs, which means it could be lost in the event of a divorce, lawsuit, or even a bad investment. So as an example, let's assume that you and your spouse make a gift to your son or daughter and they commingle those assets. If they later get divorced, their spouse could end up with a significant portion of the funds you gave. There's also a potential capital gains tax trap. If you give appreciated assets such as a house, real estate, or stocks, your recipient inherits your original cost basis, which could mean big capital gains tax issues when they sell. On the other hand, if they inherit the asset from you instead, they get a stepped-up basis, eliminating that tax. So for example, let's assume you bought $10,000 worth of a stock many years ago and it's now worth $100,000. If you give that stock to your kids now, you've given them your basis in the stock, which is $10,000. If they then turn around and sell that stock, they would owe capital gains tax on the $90,000 of gain. However, if they inherited that stock from you after your passing, the basis would adjust to the fair market value at the time of your death of $100,000. If they sold it then, it would not be subject to the capital gains tax. So as you can see, the law is tilted towards inheriting versus gifting. Now, I'm certainly not saying that you should not make gifts. It can be a wonderful planning tool. However, you need to be careful when doing it. So, how do you gift wisely while avoiding these pitfalls? Well, here are a few powerful strategies. First, consider using trusts. By leaving assets to your children and grandchildren in properly prepared trusts, you can avoid probate, achieve the basis adjustment, and also protect the gifts from lawsuits, divorces, and poor money management skills. If you're going to gift highly appreciated assets, do it carefully. Consider the tax consequences before gifting a highly appreciated asset like a stock or a property. Also, you should take advantage of the $13.99 million exemption now before it drops in 2026. Gifting is an amazing tool for tax savings and family wealth planning, but only if it's done correctly. If you want to make sure your gifts are structured properly and legally protected, visit us at roulettelaw.com to discover more and to schedule a consultation to discuss your own planning goals. I'm also going to be hosting a masterclass where I'll be revealing strategies I use with my private clients and their families to help them avoid probate, save on taxes, protect the money they leave for their kids in the event they get divorced, and much more. And you can join us by signing up at the link in the description below. I hope you found this video helpful, and I look forward to seeing you in the masterclass or an upcoming video. Be well.